Hi everyone, my name is Kalan Karuppana.
Hi, I'm Bryan Melvin, and we both go to Basis Chandler in Arizona. And we chose Uber to be our company for the 2025 YIS Global Stockfish competition. And today, we will take a deep dive into Uber to explain why we give it a buy rating with a strong potential for the foreseeable future. Founded in 2009 by Garrett Camp and Travis Kalanick in San Francisco, California, Uber, traded under the ticker Uber, set out to revolutionize transportation with a vision of convenient, affordable, and sustainable mobility for all. Today, Uber dominates ride-sharing across over 70 countries, generating about $44 billion in revenue as of 2024. The company also has three key segments: mobility, which includes ride sharing, delivery, which includes Uber Eats, and freight, which includes trucking logistics, all powered by cutting edge AI to optimize its vast network. In the past year, Uber's price has dropped by about 5%, which could show a lack of investor confidence. However, during this period, the company's financial positioning has gotten drastically better, showing major year-over-year growth from 2023, which resulted in a PE ratio of about 16 times. Hence, we believe that Uber's intrinsic value is much higher than its current price of $72.75.
So we rate Uber as a strong buy with a 1 year price target of $103.74. We believe this for three main reasons. First, Uber's economic domination with competitive advantages in its network effect, brand recognition, and data availability. Second, Uber's expansion opportunities, especially in AI and autonomous vehicles. And finally, its strategic partnerships and acquisitions, which are positioning Uber for a successful future. But first, let's analyze the three industries that Uber's in: mobility, delivery, and freight. The ride sharing industry is growing at a fast 18% CAGR as more people seek cost effective and sustainable transportation, driven by rising gas and car ownership costs. Food delivery is also growing quickly at 15% CAGR, with high demand for convenience and increased mobile adoption. The freight industry is also growing as e commerce booms with AI driven logistics. With these industries on the rise, Uber is definitely well positioned to capitalize on the growth of these industries in the next decade.
Now, for competitive positioning, Uber's dominance is protected by its high barrier to entry, as replicating its AI and platform is extremely costly and complex. The threat of competition is moderate, because while regional competitors does exist, Uber's efficiency and platform growth help to stay ahead. Substitutes like public transit and bikes pose some risks, but Uber's convenience keeps demand strong. Suppliers or drivers have limited power since Uber offers the best financial incentives and the best driving experience. And although customers can switch services easily, Uber's brand name and loyalty programs, along with its strategic pricing, especially in the emerging markets, helps it maintain its competitive edge. Uber's moat is also extremely wide, with a strong network effect, which we will elaborate more later, a diversified business model, and a revenue domination over its competitors like Lyft and Didi. Speaking of Uber's revenue, it's driven by its ability to attract and retain customers with its innovative platform and superior customer experience. It's also driven by Uber One's subscription program with over 25 million members, which offer perks like no delivery fees to help keep customers within Uber's ecosystem. And finally, Uber leverages its network to create advertisements as a high profit source of revenue.
Now for the financials. Uber's revenue surged to nearly $44 billion in 2024, growing 18% year over year. Its strong 33% gross profit margin aligns with the rest of the industry, while over $6.9 billion in free cash flow provides some flexibility. EPS also skyrocketed to $4.56 per share, marking a 400% increase from 2023. Despite this growth, Uber's PE ratio of 15.95 times suggests that it's trading at a relative discount compared to the sector, showing potential for investors. So, using this data, we built a full revenue forecast for Uber by modeling bull, base, and bear cases for each business segment. Using this data alongside capital expenditures, depreciation and amortization, and EBIT projections, our DCF model estimates an implied share price of $103.74, suggesting a 42.6% upside from the current price of $72.75 as of March 31st, 2025. Our trading comps analysis also gave us a similar estimate, giving us confidence in projecting the price to increase by 42.6% in the next year.
Now, let's talk about Uber's risks and mitigations. First off, regulatory obstacles, like driver classifications, are huge. Governments worldwide are passing laws like California's AB5, which could hike costs by 30% if drivers get reclassified. However, Uber is fighting back with lobbying and lawsuits, as well as offering drivers perks like limited healthcare and above minimum pay in places like California. Market volatility is another worry, as gas prices of $3.10 a gallon nationally cut drivers' profits and may push riders to cheaper options. Yet, Uber is countering this with chip surcharges and the Uber One membership to keep drivers and riders both loyal to the platform. And competition is also fierce. Lyft and Ride, DoorDash and food delivery, and giants like USPS and Freight challenge Uber's edge. However, Uber has combated this by taking a strong minority positions in regional players like Didi and Grab in Asia to benefit from the growth of the industry, instead of directly competing with those established players, showing Uber's creativity and innovation.
For ESG, Uber is ranked at the 71st percentile out of 40,230 technology companies, according to CSR Hub. Environmentally, Uber is pushing for zero-emission rides and plastic-free Uber Eats by 2030, aiming for a fully emissions-free platform by 2040. With the integration of electric autonomous vehicles as well, the company should likely hit these goals. Socially, Uber supports their drivers with insurance from Allianz and AXA, plus safety tools like verified rider badges and conflict training. And for governance, Uber is committed to diversity, equity, and inclusion in the workplace, creating an environment of self-expression and collaboration.
All right, let's talk about Uber's AI edge. They have started to integrate artificial intelligence into everything, whether it be ride sharing, delivery, or freight. Tools like Michelangelo, launched in 2016, enhance Uber's machine learning by sharpening ETAs and efficiently matching drivers with riders. Ray, launched in 2025, helped boost efficiency by over 40 times, cut wait times, and optimize pricing with data from 80 million users across 11,000 plus cities. GeoSurge, meanwhile, uses AI to tweak surge pricing, helping match drivers with high demand zones for more rides and revenue. To simply put it, Uber's AI is transforming mobility, delivery, and freight, and keeping it ahead of its competitors. Connected to AI is Uber's future with autonomous vehicles, or AVs. AVs are slashing drivers' costs, which account for 30% each ride, and pushing Uber towards 2040 emission-free goals. After partnering with Waymo and Phoenix to roll out AVs in 2024, Uber is beginning to expand that partnership nationally by expanding to other states in cities like Austin and Atlanta by the end of this year. And Uber is not only partnering with Waymo, but also with other AV companies like Wavy and WeRide, which have the potential to cut costs up to 50% in the long term, while keeping drivers in the mix in the short term. Electric AVs, as EVs hold about 65% of the AV market, currently align perfectly with sustainability goals as well, showing how a combination of Uber and AV will be very innovative for the future of Uber.
And finally, let's end off on how Uber's gotten so massive and how it plans on continuing its growth. The network effect. Essentially, how it works is, as more riders demand Uber rides, more drivers join to get a share of the profits. And due to more drivers being in the ecosystem, wait times and fares decrease, pulling even more riders into the platform. And this effect has worked really well now, with over 161 million riders across 10,000 cities. Surge pricing also plays into this, helping to match drivers to high demand areas and keeping the rider experience the best in the industry. So, in conclusion, Uber's dominance isn't just about rides, it's about innovation, efficiency, and an unbeatable network effect. Thank you for listening, and we hope you're as excited about Uber's future as we are.
Thank you.